For many foreign investors entering Vietnam, company incorporation feels like the biggest challenge. Obtaining the investment registration certificate, completing company registration, opening bank accounts, securing office space, and finally launching operations. At that moment, many business owners feel they have successfully entered the Vietnam market. But in reality, company setup is only the beginning. Because after incorporation, the company immediately enters a much longer and more complex process, maintaining compliance in Vietnam. And for many foreign-owned companies, the real operational risks do not begin during setup. They begin afterward, during day-to-day operations, accounting management, payroll handling, licensing maintenance, tax reporting, and eventually annual audit preparation. Many foreign investors underestimate how quickly compliance obligations begin after company registration in Vietnam. Once the business becomes operational, the company may immediately face ongoing responsibilities involving accounting, tax filing, payroll declarations, labor compliance, licensing obligations, banking management, foreign investment reporting, and operational documentation. At first, these requirements may appear manageable individually, but over time, the complexity increases significantly as the company grows. And because Vietnam's compliance system is highly interconnected, weaknesses in one area often create risks in another. This is why many foreign-owned companies eventually struggle not because they failed to enter Vietnam, but because they failed to maintain sustainable compliance afterward. One of the most common patterns among foreign-owned businesses in Vietnam is rapid operational growth combined with weak internal compliance coordination. Sales increase, employees are hired, transactions expand, operations become more complex, but compliance systems often fail to evolve at the same pace. Accounting providers may focus only on monthly filings. Payroll records may become inconsistent. Supporting documentation may not be maintained properly, and management may not fully understand how tax, labor, accounting, and legal obligations connect together operationally. For a while, these weaknesses remain invisible, but eventually, they begin surfacing during audits, inspections, licensing procedures, or banking review. Many foreign investors view accounting as an administrative support function, but in Vietnam, accounting becomes one of the central pillars of operational compliance. Because accounting records affect tax exposure, audit readiness, payroll compliance, profit repatriation, licensing procedures, investor reporting, and operational credibility. If accounting systems are weak, incomplete, or poorly coordinated, the company may gradually accumulate hidden compliance risks without realizing it. This is why experienced foreign investors increasingly prioritize accounting quality and documentation discipline from the early stages of business operations. One of the biggest misconceptions foreign-owned companies have in Vietnam is believing audit preparation begins when auditors arrive. In reality, audit readiness is built gradually throughout the year. Every invoice, every contract, every payroll declaration, every tax filing, and every banking transaction contributes to the company's long-term compliance defensibility. If documentation is incomplete or inconsistent, those weaknesses eventually become visible during the annual audit process. And once auditors begin identifying problems, correcting historical issues becomes significantly more difficult and expensive. For many FDI companies in Vietnam, annual audits become the moment hidden operational weaknesses finally surface. Many foreign investors manage compliance through multiple disconnected providers. One provider handles accounting, another manages payroll, a separate consultant supports licensing, and legal matters are addressed only when issues arise. At first, this fragmented structure may appear cost-effective, but over time, communication gaps begin creating hidden operational exposure. Payroll records may not align with accounting treatment. Licensing obligations may be misunderstood. Supporting documentation may become inconsistent, and no single advisor oversees how all compliance areas connect together. Eventually, the company discovers that isolated compliance functions without coordination create significant long-term risk. Many startups and SME foreign investors entering Vietnam understandably focus heavily on minimizing operational costs during the early stages. And compliance support is often selected based primarily on low fees. At first, everything may appear functional. Reports are submitted, taxes are filed, operations continue normally. But later, during audits, tax inspections, banking procedures, or expansion planning, weaknesses begin appearing. Incomplete records, weak documentation, poor communication, incorrect accounting treatment, or operational structures that cannot withstand professional scrutiny. At that point, management realizes the original compliance structure was built for administrative filing, not long-term operational sustainability. Imagine a foreign entrepreneur establishing a technology company in Vietnam. The incorporation process is completed successfully. Operations begin quickly, the business grows steadily, different providers handle accounting, payroll, and administrative support separately. For several years, management assumes compliance is functioning properly because no major issues appear. But during annual audit preparation and future investment discussions, serious weaknesses emerge. Supporting documentation is inconsistent. Payroll records do not align fully with labor declarations. Intercompany transactions are poorly documented, and accounting treatment creates potential tax exposure. The company then spends months reconstructing records and coordinating corrective action under significant operational pressure. Management realizes something important. The real challenge was never company setup. It was maintaining sustainable compliance after setup. This situation is extremely common among foreign-owned companies in Vietnam. At LTS Law, we believe foreign investors need more than incorporation services. They need long-term operational guidance. This is why our role extends beyond company setup into broader compliance coordination and risk management. We help foreign investors assess operational compliance risks, coordinate legal and accounting oversight, review documentation structures, support labor and licensing matters, and identify potential weaknesses before they escalate into larger operational problems. Although LTS Law does not directly provide accounting or audit services, we help clients identify professionally assessed accounting and audit partners experienced in supporting FDI companies in Vietnam with stronger transparency, responsiveness, English communication capability, and practical compliance understanding. Because sustainable business operations require more than successful incorporation, they require sustainable compliance systems afterward. Many foreign investors focus heavily on entering the Vietnam market, but long-term success depends heavily on what happens after the company is established. At LTS Law, we help foreign investors understand that compliance is not an isolated administrative burden. It is part of protecting the operational stability, credibility, and scalability of the business itself. If you are operating or planning to establish a foreign invested company in Vietnam and want guidance on maintaining compliance, audit readiness, or selecting suitable accounting and audit partners, book a consultation with LTS Law. Because in Vietnam, the journey from company setup to audit readiness is not just about compliance. It is about building a business capable of operating sustainably over the long term.